For the past 2 decades, global markets operated under a single, unquestioned axiom that cheap money was a permanent feature of the universe. Japan supplied near zero cost yen, the Federal Reserve stepped in with dollars at every hint of crisis, and the global banking system stood ready to expand its balance sheet. This mechanism ran so smoothly for so long that capital forgot a fundamental truth. This was never a law of nature, it was a conditional arrangement. Now, that foundation is fracturing. The surface symptoms are visible to everyone. Heightened yen volatility, divergence in U.S. equities, and mounting pressure across emerging markets. But the real story isn't a single headline. It is a structural deceleration of the global liquidity cycle itself. Today, we look past the noise to answer one critical question. As the world's cheapest capital reprices, where will the remaining liquidity go? To see where the system breaks, we must understand how it was anchored. For 20 years, global capital flow was sustained by a remarkably efficient macroeconomic triangle. First, Japan, functioning as the ultimate provider of cheap funding. Second, China, suppressing global inflation through its sheer manufacturing capacity. And third, the United States, offering the deepest, safest asset markets to absorb that global capital. The result was a prolonged regime of low inflation, low volatility, and structural leverage. In this world, borrowing was the only rational play, and holding cash felt like an anachronism. The purest expression of this machine was the yen carry trade. Borrow at zero in Tokyo, convert to dollars, and harvest yields in New York. As long as the interest rate differentials held, the machine printed money. But when those differentials shift, the entire complex must reprice. Today, all three pillars of this symbiotic system are moving simultaneously. Consider the first pillar, Japan. For a generation, global risk models treated Japanese interest rate risk as effectively zero. Borrowing yen was as passive as breathing. Nobody modeled the alternative, but with the structural return of inflation, the Bank of Japan can no longer pretend rates are frozen in perpetuity. A move from 0 to 50 basis points might look trivial on a chart, but its systemic impact is profound. Countless global strategies were built on the premise of permanently free yen. This isn't a currency story, it's a wholesale repricing of global hurdle rates. Look at the plumbing. Trading volumes in yen interest rate derivatives, specifically overnight index swaps, OIS, have surged. What is this telling us? It tells us that institutional capital is no longer debating macro theories. It is actively buying protection for a risk it ignored for decades. Global desks are compressing years of neglected risk adjustments into a matter of months. This isn't a panic, it is a delayed structural reckoning. The second inflection point is China. Let us correct a widespread misconception. The issue is not that China has stopped exporting deflationary goods. On the contrary, with its domestic economy undergoing a balance sheet repair amid real estate and local debt pressures, China's impulse to export excess industrial capacity is stronger than ever. The actual disruption lies in the plumbing. The global conduits that once absorbed this supply have narrowed. The geopolitical landscape has shifted. Western economies, intent on protecting domestic industries, have erected tariff walls and industrial barriers. Low-cost goods that once flowed seamlessly now face severe frictional friction. Therefore, the shift in global inflation is not a supply-side disappearance. It is a political balkanization of trade channels. The water is still flowing at the source, but the riverbed has been narrowed by policy. This is why the global price baseline is losing its stability. Developed market central banks can no longer assume that external deflation will unconditionally underwrite their domestic policies. This is a fundamental regime change in the global pricing framework. The third shift is perhaps the most consequential. Historically, the United States acted as the primary exporter of liquidity to the rest of the world, fed by quantitative easing, dollar outflows, and U.S. Treasuries acting as the premium collateral underpinning the global financial system. While that architecture remains, the U.S. economy has developed a secondary, powerful function. It has simultaneously become the world's largest absorber of capital. There are two distinct gravitational wells driving this absorption. The first is the U.S. Treasury. Facing unprecedented fiscal deficits, it must continuously issue debt to roll over its obligations. When the Treasury issues bonds, cash moves out of the private banking system and into the Treasury General Account, TGA at the Fed, temporarily draining short-term liquidity. But there is a vital counterintuitive twist. Treasury issuance doesn't just absorb cash, it supplies collateral. In the repo markets of Wall Street, U.S. Treasuries aren't just debt instruments, they are liquidity. Systemic tightness is not caused by a simple lack of cash, but by an allocational mismatch between cash and collateral. When primary dealers are forced to absorb vast quantities of debt, their capacity to finance the broader market contracts, causing volatility spikes in the secured overnight financing rate, SOFR rate. The second gravitational well is the U.S. real economy. The capital expenditure required for artificial intelligence, advanced semiconductor fabrication, domestic energy infrastructure, and supply chain reshoring represents a colossal physical demand for dollars. Thus, the U.S. finds itself in an extraordinary position. The Fed is shrinking its balance sheet. The Treasury is expanding debt issuance, altering the collateral mix, and the domestic real economy is locking up real capital. The world's primary faucet has transformed into its primary sump pump. This is not an impending catastrophe, it is a structural realignment. The ultimate source of global capital has become its ultimate competitor. Beneath the surface sits a vast institutional network known as the offshore dollar system. A significant portion of dollar funding does not originate on U.S. soil. It is generated in London, Tokyo, and Singapore via interbank, balance sheets, and FX swaps. Stripped of its complexity, this system relies entirely on trust, continuous rollover financing, and marginal liquidity providers. Historically, Japanese banks. Modern cross-border arbitrage has evolved beyond the textbook borrow yen, buy dollars model. Institutional allocators manage risk through FX swaps, where nominal exchange rates matter far less than hedge funding costs, the cost of neutralizing currency risk, quantified by the cross-currency basis. Bluntly put, this basis is the protection insurance of the offshore system. If Japanese domestic yields rise, or if Japanese institutions adopt a more conservative posture, the cross-currency basis widens. The premium to swap yen into dollars escalates, rendering historical carry trade positions economically unviable. The risk is not a dramatic failure of Japanese megabanks. It is their quiet retreat. The most vulnerable nodes in global finance are those dependent on daily rollover liquidity, highly leveraged funds, and illiquid credit assets. True systemic risk rarely announces itself with a sudden crash. It manifests as a slow, creeping evaporation of liquidity, continuing unnoticed until asset prices can no longer support the narrative. The mechanics inside the core short-term funding markets are direct. When the Treasury clearing cycle draws reserves out of the banking system and into the TGA, repo capacity tightens, and the SOFR index exhibits heightened volatility. The hidden driver is the supply imbalance. The Treasury is extracting cash while simultaneously saturating primary dealers with collateral. If a handful of Wall Street's primary market makers are forced to carry too much debt inventory on their balance sheets, their capacity to intermediate and extend credit to the rest of the financial system diminishes. This micro-friction within our financial plumbing is the structural reality of cheap money disappearing. The offshore dollar system is where pressure first becomes visible. Euro-dollar markets, the dollar funding that occurs in London, Tokyo, Singapore, and offshore financial centers, depend on rolling short-term commitments. Japanese banks are not marginal players here. They are among the largest non-US providers of dollar liquidity in the offshore system. When their domestic rate environment changes, their appetite for offshore dollar provision changes first, quietly, through reduced bid aggressiveness, before any formal policy shift. The relevant question for any rational investor today is not when the next headline-grabbing crisis will erupt. It is this: in a regime where the cost of capital is structurally higher, where is your asset positioned in the global hierarchy? We are witnessing a strict trifurcation of the liquidity world. At the top tier sits sovereign immunity, short-term U.S. Treasuries, and premium cash-equivalent liquidity elite. At the middle tier lies structural growth, assets anchored by heavy, real-world capital expenditure, critical infrastructure, computational baselines, and physical energy moats. And at the bottom tier is pure speculation, a graveyard of illiquid zombie corporations and overvalued assets that only existed because capital was free. This is not a panic. It is a delayed structural purification. The tide is not vanishing. It is reversing direction. And a reversal of this scale is deceptively slow at the onset, right up until the moment it sweeps everything away. Look back to 1997, one of the most brutal lessons in economic history. Many are quick to draw parallels to today, but we must be careful. 1997 was not ignited by a simple Japanese rate hike. It was a far deeper structural misalignment. The crisis was not caused by a speculative attack from George Soros, nor did any single nation suddenly turn evil overnight. The real lesson is much colder. Crises manifest when the retreat of marginal liquidity collides with deep-seated balance sheet mismatches, when Japanese megabanks, the primary financiers of the offshore dollar system, were forced to retreat. The underlying vulnerabilities of Southeast Asia, short-term debt, and currency mismatches were instantly laid bare. This holds true today. Financial crises rarely begin at the strongest points of the system. They always begin at the links most addicted to cheap money. The most exposed entities today share a recognizable profile. Dollar-denominated liabilities funded in local currency revenues, short-duration funding, supporting illiquid assets, valuations built on rate assumptions that no longer hold. This profile appears in certain emerging market corporate sectors, in highly leveraged credit structures, and in any asset class where the investment thesis depended primarily on the cost of money remaining structurally low. To synthesize the parameters of this new landscape, the Japanese yen is no longer a risk-free funding subsidy. Global inflation has lost its unconditional external backstop, and the United States is operating simultaneously as the arbiter of liquidity and its largest competitor. In this segmented hierarchy, the old playbook of blind leverage and rapid turnover is obsolete. Structural resilience belongs exclusively to sovereign-grade assets and businesses defended by physical energy and computational infrastructure. Therefore, the question worth asking is not whether the markets will experience a tactical pullback tomorrow. It is, in a world where cheap money is no longer the default, where is your capital actually positioned? The tide is not disappearing, it has simply changed direction, and the nature of macro tides is that they move with deceptive stillness, right up until the moment they submerge the horizon. This is long view. Stay rational. See further. We'll see you next time.